I'm Darius McDermott from Fund Calibre, and today I'm delighted to be joined by Tom Hanson, co-manager of the Aegon High Yield Bond Fund. We're going to talk about all things super exciting and high yield. Tom, good morning.
Morning.
So let's just do a quick recap of the fund. It's high conviction, flexible approach to high yield investing. What in practice does that mean to you and to people who potentially might buy the fund?
Yeah, I think we want to make the most of our analyst platform. We've got a lot of good idea generation, and we are firm believers that performance is generated from the bottom up in high yield, as most people would be. But we think that we can create a concentrated portfolio of 100 to 150 line items that really juices the most of that, if you want. I know some of my peers will perhaps take a slightly more diversified approach and run 300, 500, even more, up to 1,000 line items. I think the average is 300. But for us, picking your best ideas, this is very much a best of the best global high yield ideas fund, representing the ideas in conviction size and then marrying that with a top-down overlay is the key way that this fund generates performance. But you need to remember as well, alongside that, we are very index agnostic, and that is a hugely important part of what this fund does and how this fund unlocks value, because we're firm believers that the benchmark is a suboptimal construct, should we to put it like that. The biggest weights in a benchmark that governs our world are those that have the most debt outstanding. So
yes,
don't use that as your blueprint to create a portfolio. So we don't. We start with a blank sheet of paper and we build it from the bottom up from there.
And 100 to 150 in an equity fund would be very diversified, but in bond world, that actually isn't the case, is it?
No, I think, it's an asymmetric payoff, right? In equity world, you're paying for, I guess, unlimited upside. In our world, you've got a strictly limited upside. You've got your coupon. You've got a bit of a takeout above par, but in reality, it's about protecting the downside. So we think that's the right number. At times we're going to be towards the bottom end of that range, perhaps when we're a little bit more bullish. At times when, as we are now, we're a bit more cautious, we're perhaps going to be towards the top end of that range. But as an effective operating environment, that's kind of how we do it.
Just finally then, on the flexibility and the index agnostic, I know that you've only got a small percentage US high yield, sort of 15-ish%. What sort of position is that in the benchmark, just so we can measure the quantum of your agnostic behaviour?
So the benchmark world, and we want to beat our benchmark, by the way, right? We just don't agree with how it's constructed. Like a benchmark global high yield world is probably best thought of as 60% US high yield, 60, so 20% Europe, 20%.
To my mind, we're actually highlighting that you are flexible and agnostic. That's not that you wouldn't go back to the US when the opportunity arises. If and when it does.
100%. And, I could show you a chart that shows our historical allocations, and there'll be times when we've been heavily weighted towards the US and far less heavily towards Europe, or perhaps 0 times emerging market. The key thing when you're considering our fund is flexibility, to your point. We're going to go where the opportunity set is. We're going to go where we think the best risk-adjusted returns are going to be available to us. And at this point in time, that is manifestly not the US high yield market. It is European high yield, and in particular subsets of European high yield, sterling, we can talk about, and it is hard currency emerging market, just not the US, but that won't always be the case.
So let's talk about the high yield market then this year. It's been a challenging start to the year. We obviously have had the conflict in Iran and Middle East, and that's certainly had a lot of impact on volatility and oil and energy. And there's the whole AI disruption thing that's going on. Mostly been an equity story, but started to enter the bond market as they now have to borrow to fund this capex, and and entering the high yield as well. So tell us a little bit about sort of what you've managed to do to stay ahead this year.
Yeah, it's a difficult year this year. I mean, there's rarely an easy year in high yield, if truth be known. That's part of the joy in working in the high yield market. A lot of volatility, but a lot of opportunity. But yeah, I mean, the worries have been stacking up. So clearly the geopolitical situation in the Middle East, which obviously at this point in time is showing signs of causing pressure once again, is one thing. The AI disruption, I mean, that's going to be a concern for everybody, no matter what market. We can talk a little bit more about that. Also, private credit, what's going on there, potential transmission mechanisms. So you kind of got a few different pockets of trouble, potential trouble, if you like. The key thing is spreads are still pretty tight, so your margin for error is pretty thin in our market. But from our perspective, it's really been about focusing on the best parts of high yield that we can and avoiding perhaps some of the pitfalls. So we've been quite clean from a sectoral perspective this year. We haven't owned much chemicals, which has been, if any, actually at points, which has been a troubled sector. We've been almost maximum weight our energy exposure, about 20%.
Which has been a nice sort of barbell for that sort of oil price rise and conflict.
Totally.
The chemical industry has suffered to get presumably the
margin compression, cost pressure. Exactly. Energy has obviously benefited for certain reasons, so we've done well there. Some of our bigger top-down calls have worked, such as Europe versus US. I think on a currency adjust, 100% currency hedge basis, Europe is streets ahead now. Sterling has continued to do very well, and actually the bright spot has been emerging market high yield, which has delivered by far the most of the subsets of global high yield in total return terms.
So I know we're going to talk a little bit about emerging markets in a bit, but I'm interested in the sterling bit because obviously we live in the UK. We earn in sterling, we spend in sterling. Yet you say it's a almost not an emerging market. Let's not quite go there, but
no, I definitely didn't say that.
An unloved market.
An unloved market,
where you're able to get a yield premium.
100%. And as a rule, that's kind of the sort of thing that me and Mark would like. So, we run the fund to try and capitalise on opportunity. If we can find a more off-the-run opportunity, so much the better, or so more the better. Sterling high yield is that. And really, you can go all the way back to the original Brexit vote in 2016. Before that, on a pound-for-pound basis, sterling used to be at least perceived to be a higher quality market than its corresponding euro equivalent. But ever since then, it's traded with a spread premium. We've obviously had a difficult political situation, continue to have political fluctuations and volatility. But what it means is there is perhaps less of a dedicated buyer base for sterling high yield. And what that has to mean is a lot of sterling bonds trade cheap. Now, it's not as simple as owning everything in the sterling high yield market. There are winners and there are losers, but there is a lot of opportunity there, and we continue to benefit from them.
For more information on the Aegon High Yield Bond Fund, please visit fundcalibre.com.